So how do you set a proper stop loss as a complete beginner? What's going on, guys? It's Ricky here with Tactical Solutions. If you're new to the channel, make sure that you subscribe. And if you learned something new, make sure you drop a thumbs up. So I'm going to start sharing my screen so you can see exactly what it is that I'm looking at over here. I'm going to give a series of examples. I actually shared this example with my Learn Plan Profit group. They liked it so much that they're like, hey, I think that this would be very useful information if you share it on YouTube for someone that, might be making the same mistake. And the mistake that we want to talk about is how many times have you guys entered a day trade or a swing trade, right? You're entering a position and you're trying to manage your risk. You're trying to stay disciplined, but when you're holding yourself accountable and you set a stop loss or a trailing stop loss, maybe you're setting it too tight, maybe you're setting it too far apart, and you're either losing or getting stopped out very quickly and or losing more money than you're comfortable with, right? I'm really big on position size, so please just let me explain the overall example. And after, I'm going to give an analogy on why I find it to be so useful. So again, I really hope that you learned something new, and just friendly reminder, I do trade live every day. So I don't just post my profits and show you a fancy, green number or a fancy red number and just be like, hey, this is how much I made or this is how much I lost. I actually trade live every day exclusively for my Learn Plan Profit group. So if you're tired of guessing and you're actually wanting to learn more about the market and what it's like to see someone buy and sell a stock, again, click that second link down below, learn more about our Learn Plan Profit group and see if it's a good fit for you. We are running our biggest sale right now for the end of the year sale, and we'd love to have you as a part of the team if you see us to be a good fit for you. So let's go ahead and jump right into it. I'm going to use Tesla as an example. I have an open swing trade on it, up $2,300 on the open, but it doesn't matter. I don't plan to sell it anytime soon. Someone was asking me like, hey, Ricky, when do you plan to cut losses? And again, this is a really big question for a lot of people because, we all trade with different dollar amounts. So, if I'm down, let's say I'm down $2,000 instead of being up, someone would be like, oh my God, Ricky, you should be cutting losses on that. But they're not taking into consideration of what my plan is, what my intention is. And this is why I wanted to make this video for you guys. So I'm going to do this in instead of using the dollar amount that I'm trading with, I'm just going to use $10,000, right? A very common mistake that I see a lot of beginners make, and I've made this mistake more times than you have. And I'm using myself as an example. A very common mistake I've made is, let's say you're trading with $10,000. That's what's in your trading account. You're trying to swing trade, right? You want to go in for a swing trade, which means that you're not buying and selling it within the same day. You're holding it for a number of days because you see, bigger recovery potential over a period of time. So for Tesla, obviously it's very oversold. For some people, this could offer a good swing trade opportunity, meaning that for a number of days it could begin to rally, and you can make a decent return, right? Well, on average, a beginner trader would be like, okay, well, I have $10,000 to work with, so I'm just going to buy $10,000 worth of Tesla stock right now at 123, fingers crossed, and hopefully it begins to recover. But to manage my risk, I'll set a stop loss. Let's say that, we call it a golden ratio if you're part of my Learn Plan Profit group. It means, what is your upside potential versus your downside risk? You always want to have a ratio that is that correlates to your success rate. So if you're someone that is just getting started and you don't have a very high success rate, you're probably going to want to be closer to a 5-to-1 ratio, meaning that 5% upside for every 1% you risk. If you're a little bit more consistent, then you can choose to be a little bit more aggressive, right? A 2-to-1, a 3-to-1, whatever the case might be. The really cool thing about this is that, the beginner trader that starts trading with $10,000, they might just be hoping for the best. And sometimes they might get lucky and it might begin to rally. They lock in profits, and based off of what, on the day chart for Tesla. So I'm going to zoom in just so you guys can see very clearly. I'm going to use my little trend line tool here. And from the current price point, if we hit that moving average, that's around a 37% return, right? 37% ROI. That's a huge ROI with $10,000. We're talking about a $3,700 return, right? That's what I have labeled right here. That's my max potential profit in a perfect world. We obviously don't live in a perfect world, but I just like using that as an example. Now, I'm using the 5-to-1 ratio as an example. And the reason I'm using that as an example is I'm just assuming that you're an absolute beginner, that you have a lower success rate. So I'm trying to be a little bit more conservative on that side of things. Because it offers a 37% ROI potential for this swing trade, right? That's my upside potential. At that 5-to-1 ratio, I can tolerate a 7.4% loss. 7.4%, is it still a decent amount, right? $10,000, 7.4%. We're talking about $740. I mean, that's a decent chunk. I don't know if a complete beginner would be comfortable, risking that or tolerating that. So let me explain, right? You always hear me talk about position size. Yesterday is a great example of this, right? I made over $12,000. I uploaded the video, day trading TQQQ. But if you look at TQQQ only moved, it ended the day at break even. It was 0%, right? How did I make money when TQQQ was break even? By managing my position. There's nothing wrong with buying at oversold levels. But when you understand that we do not have confirmation, we are not fully indicating signs of a reversal, this is where you can really get into danger, right? What's one of the most common mistakes when you are buying before confirmation? Let's say the $10,000, you buy at 123, and then it continues to sell off. Now you have no options, right? You were hoping for it to recover, but now if it begins to sell off, your only option is to manage and mitigate your risk and accept your max loss of $740 if you hold yourself accountable, right? Or you can cut losses sooner. What is a way around that? So the way that I approach it, I'm not saying that you need to, I'm just saying that this is the way that I have found a more effective way to dollar cost average into a swing trade. So let's say that I'm working with $10,000. It's the exact thing that I'm actually doing with my Tesla position right now. Let's say that I have $10,000 to work with. We have a rule within Learn Plan Profit. I'm going to have a more conservative rule for you guys. I'm thinking that you're a little bit more on the beginner side of things. We have a rule that you should never be invested before confirmation more than 20%. But as of right now, I'm going to say 10% or less. Just being super conservative. That means that out of the $10,000 you have in your trading account, the example would be your initial position, when it begins to show signs of a support or showing signs of a reversal, it should not be larger than $1,000. 1,000 is equivalent to 10% of $10,000, right? It's a weird way of thinking. Well, why would I only buy $1,000 if I have $10,000 to work with? Because it's not certain that it's actually going to begin to recover. This is where the dollar cost average comes in. But the great thing about this is you might be like, well, Ricky, I'm gonna miss out on all the potential profit if it actually does begin to recover. You can buy in increments, right? There's no such thing as a perfect trader. There's no such thing as a perfect investor. You will never be perfect. I would rather be calculated in the way that I take advantage of an opportunity. Let me explain why. Yes, if this thing begins to skyrocket, you will have the dollar cost average and your average purchase price will be higher than 123. But guess what? It's still a successful trade, right? Direction is in your favor. You waited for confirmation and you're building healthy habits, right? And you're minimizing risk. Let me explain. If you're in with 10%, and I want to talk about worst case scenario. Worst case scenario, if you're in with 10%, which is $1,000, you were originally trying to go in with $10,000, but by only going in with $1,000, if this thing begins to sell off, and even if it does lose the full 7.4%, that's $74. Think about that difference. From $74, right, from $740 down to $74. How much more effective will you feel even at worst case scenario? Because I can only speak from my experience, but I know that I've made this mistake many times where I go all in the very beginning, fingers crossed, it begins to go south, and I feel hopeless. I feel like the market's against me, and I want to blame everyone else for my lack of success. But guess what? It is your fault. It is my fault, right? It is our own fault for initially taking a position that was too aggressive that we couldn't tolerate, right? Never take a position in which you cannot tolerate. By going in with 10%, yes, you do run the risk of potentially missing out on huge profits because you're only lightly invested. But guess what? You're at least more calculated and more effective, and you can always dollar cost average as you get that confirmation. But the great thing about this is on worst case scenario. Even at worst case scenario, if you lose 7.4% of $1,000, losing $74 is a lot easier to tolerate. You're going to think more clearly and less emotionally. And for some of us, that's a huge win, right? That promotes healthy habits. That, yeah, you took a risk by still going in with 10% before confirmation, but you did it in a calculated way, just like I did yesterday, right? The market sold off originally. TQQQ was down 3 or 4%. I went in, I started dollar cost average, and I started to buy a couple of shares, right? I think I bought around like $50,000 worth of TQs. I trade with over $500,000. TQs began to skyrocket the last hour of the market open, and guess what? I stepped on the gas when direction was in my favor, and that's the beautiful thing about this. You shouldn't be afraid to take advantage of any opportunity. It's all about position size. I can take advantage of the riskiest opportunities, but if I only buy one share, if I manage my risk and I barely buy anything where it's enough money for me to take it seriously, but not so much that even at worst case scenario, I become an emotional mess, that's an effective position, right? That's right where I'm encouraging you to take time and find that balance. For some of you, 10% might be too light. For some of you, it might be too aggressive. There is no perfect number for the masses. Your job is to simply implement progress. And I hope that this video can make you aware of if you often find yourself stop lossing out too quickly and or stop lossing out too kind of like late, where the dollar amount is kind of like a tough pill to swallow because of how much you're down, then this approach supports both cases. Because if you're stopping out too quickly because of how much money you don't want to lose, by taking a smaller position, you will be more willing to take a larger percentage loss, but it's a smaller dollar loss because of a smaller position size, right? And then now when it comes down to the overall dollar amount that you're actually losing, even at worst case scenario, you're still going to feel calculated. And if you still have to accept that loss, that 7.4%, then so be it, right? You can accept that loss, and it's a much easier pill to swallow. That, yeah, it's still a red trade, but it's not something where you bit down more than you can chew. And yet it's asking yourself, right? Anytime that you take a trade, anytime that you open a position, it's a position that's open to risk. Your job as a trader and your job as an investor is to minimize that risk and to not be irrational. And in my opinion, by managing your position size and keeping it light early on is something that aids both ideas, right? Both issues, and promotes healthy habits. And this is why I think managing your position size early on a reversal is so important, because not just on worst case scenario does it allow you to think clearly, but even on best case scenario, you're still able to dollar cost average and feel effective during that rally, right? You feel in control. And that's not something that everyone can say when they're fully invested in an initial position and then things begin to go south, right? The analogy that I want to give you, and again, it's just kind of like my dad analogy, and I make these jokes all the time with our Learn Plan Profit group, is I had a member ask me, Ricky, why do you buy, a stock? I was investing in Tesla stock. I was investing in Amazon stock. And if you guys have recently seen, Tesla and Amazon stock have recently sold off, right? Why are you buying these stocks if they're still selling off? And that's very true, right? I talked about me only buying a small amount of these stocks, right? Because they still are not indicating signs of a reversal or a recovery, but he didn't understand why, right? And the example that I gave him, the analogy that I wanted to use is, my job is to seek opportunity, right? I'm never going to be perfect, but if I see that the current price point is attractive enough where the ROI potential makes sense, right? My job is not to avoid risk. My job is to manage it. So that is why I take a small enough position where I feel like I have enough money in it to take it seriously, but not so much that even if things get worse, I become irrational. I don't need it to recover now. But if it does, I will buy more when it does, right? And the analogy that I want to give you is, imagine yourself as someone that is trying to collect water. You're in the desert, right? It's about to rain, or it looks like it's about to rain, right? The great thing about that is you have 50 buckets to work with. There's clouds outside, and the idea would be, okay, well, it's nighttime and you're going to go get some rest. So if it starts to rain overnight, you're probably not going to be quick enough to take them out there. So the idea would be that if I begin to see clouds, if I begin to see signs of rain, I can maybe put 1 or 2 buckets out there, right? Just in case I don't have to put them all because, the wind might take them. But I'm okay with putting one bucket out there. So if it does begin to rain, I begin to collect some of it. But if it doesn't and that bucket falls and it doesn't end up raining, then it's okay. It's a risk that I'm willing to tolerate, right? But if I have that one bucket out there and then I begin to see those sprinkles, right, I'll start putting out more buckets out there, collect more rain, right? It's kind of like when the stock begins to indicate signs of reversal. I'll start adding more to it. Once I get that full-on confirmation, I'll start to work towards getting closer to those 50 buckets. At the end of the day, do I always have to use those 50 buckets to try to collect the most rain? No, because again, it's a little bit more difficult to tolerate, right? If the wind were to pick up and spill some of those buckets. The idea is again, it's managing your position size at risky levels. Yes, markets are very oversold, and yes, markets can always get cheaper. But that shouldn't scare you of taking advantage of an opportunity. There's this very famous quote saying that every previous recession is viewed as a missed opportunity, but every current recession is viewed as a risky time to invest. Think about it. It's all perspective, because you can always look back and be like, hey, I should have done this better. But when you're in the position, it's hard to look into the future and be like, this is a good place to put myself in, to tolerate the short-term pain, hopefully for the long-term gain. But it's what seasoning comes with, right? The more experience that you gain, the more recessions that you experience, the more comfortable you will be buying into them, right? And then riding them back when they recover. You should never be afraid to take advantage of an opportunity. It is simply your job to manage and mitigate that risk. I hope that this video did a decent job in explaining why position size is a great thing to take into consideration when trying to manage your risk, especially with stop losses, swing trades, and even day trades. So if you have any questions, again, you can always reach out to me via Discord, and that's going to be that first link in the description, or send me a direct message via Instagram. I am verified, and that's that third link down below. I only have one Instagram account. I only have one YouTube account. I will never message you first. I don't have a WhatsApp. I don't have a Telegram. My team will never reach out to you. I don't manage other people's account. I offer one thing, and it's my Learn Plan Profit Group. It's the second link in the description of this video. We're running our biggest sale. You heard me talk about them. It's the only team that I work with on a daily basis, and they get to watch me trade live every single day. So if you want to learn more about it, take 2 minutes, click the second link, and see if our team is a good fit for you. Don't forget, today is the last day to enter our PS5 giveaway. And if you want to learn more about that, that's going to be the fourth link in the description, and the giveaway winner will be selected on Monday. So I appreciate your time. Hope that we earned a thumbs up. Please consider subscribing. And like always, let's make sure that we end the year on a green note. Take it easy, team.